The central daily pivot is one of the most powerful indicators. It can tell you a lot about the potential movement of the upcoming day, and it can offer you a bias about the current day. Knowing the location of this pivot will allow you to know the pulse of the market and will also provide you with decent entry points. The current sentiment of the market can be estimated when you look at the previous day pivot compared with today's pivot. If the current pivot is above the previous one, that would be considered bullish. You want to find long signals in this case. If today's pivot is below yesterday's pivot, this is bearish, and you want to concentrate on short signals. In this chart, we added the central pivot points. These are different from other indicators like moving averages or other oscillators because they are stationary and remain fixed at the same prices during the day, which is something I like a lot. Here, the market is below the pivot level, which is lower compared to the previous one, and makes a move upward. At this level, it found resistance. This is a good area to take short trades. And here, the market was above the central pivot and made a move downward and found support at that level. You can see that the central pivot represents an essential support or resistance zone derived from the previous day's values. If you are used to monitor the recent swings to determine the trend, like higher highs and higher lows, add the central pivot and start doing the same thing. Monitor consecutive highs and lows, but on pivots. Another indicator which will help you to trade supply and demand is Heikin-Ashi. That's because the candles on the Heikin-Ashi chart display more consecutive colored candles, making it easy to identify past price movements, current trends, and of course supply and demand zones. The first Heikin-Ashi color change after supply or demand retest is an important signal to analyze. The rules of supply and demand trading using Heikin-Ashi color change are simple. You look to buy when price approaches a demand level and bounces upwards, forming a green Heikin-Ashi candle, ideally with no lower wick. You expect the price to increase, and you want to trade an upcoming price swing. And you sell when the price reaches a supply level and bounces downwards, and Heikin-Ashi candles change from green to red, ideally with no upper shadows. In this chart, we identified this supply zone. You will be looking for a large candle or a series of candles in downward direction. The stronger the move, the stronger the demand or the supply zone is. It suggests that price will move in the same direction again when price returns to this level in the future. A good entry method is to wait for a confirmation at the retest of the supply zone. You wait for a Heikin-Ashi color change. You monitor the first reaction at a level to see if the price is pushed away off that level. If this occurs, you want to enter and ride the new wave downward when the Heikin-Ashi turn red. One of my favorite leading signals is the time-segmented volume divergence. Time-segmented volume measures the amount of money flowing in or out of a particular market, and it segments the price and the volume according to a specific time interval. The price and volume data is then compared to uncover periods of accumulation and distribution. With the help of this indicator, you will read the price action and the volume action on the same exact bars to know the true volume information you need, and to see if price and volume are in harmony or if they diverge. Time-segmented volume can confirm the move, make you suspect of the move, or can tell you if it is the end of the move and if a likely change in direction is coming. The most important aspect to look for when reading the TSV is a contradiction of trends between price and the indicator. You look for positive or negative divergences between price and TSV in order to determine potential tops and bottoms. In this example, price is making higher highs, while TSV is making lower highs. and this is a negative divergence. This would be a leading indication of a possible top. And here, price is making lower lows, while TSV is making higher lows. This is a positive divergence. This would be a leading indication of a possible bottom. Volume divergence trading is more powerful than regular divergence trading. If you want to learn more about this, go watch this video after you finish this one. Anchored VWAP is better than the traditional VWAP indicator. With classic VWAP, the calculation starts with the first bar of the day and ends with the last bar. With Anchor VWAP, you have full control. You can place it anywhere on the chart. One of the most effective strategies is to trade pullbacks to the anchored VWAP line. The most important part of the strategy is anchoring the line. The starting price that you choose must mark a shift in market psychology. It must be an important event or turning point in the market. I like to place it on the highest volume bars. High volume means there's an interest in the market. If it's combined with a move higher in price, then it is often used as a signal of a strong upward momentum. Keeping an eye on the volume will ensure that you're on the right side of the trade. So here is Netflix on the 15-minute time frame. Here is the highest volume in the previous week. We also have a shift in market structure, with a new swing low forming. We added the anchored VWAP, and the line immediately offered an opportunity to short a pullback to the VWAP. This can work for day trading, but also for swing trading. You go with the flow of the highest volume and you try to catch another wave to the downside when price comes back to the anchored VWAP. If you want to learn more about the anchored VWAP, you should definitely watch this video. This is the first lagging signal. Directional movement, or the ADX, is an indicator that measures trend's trend. ADX displays a line ranging from 0 to 100. It shows the strength of the trend, but it doesn't indicate its direction. It doesn't distinguish between uptrends and downtrends. When the ADX is below 20, you must avoid trend trading strategies, as the market is likely in accumulation or distribution phase. Here's an example. With the ADX line below 20, you can clearly see the lack of a trend, as the price basically trades within a range. Very choppy price action with no clear direction. When ADX crosses below 20, it may show the end of the trend, or better said, the movement in a non-trending zone. So when you see the ADX line below 20, forget about trend trading strategies. You may decide to apply strategies suitable for a ranging market. Look for liquidity clearouts or false breakouts. Buy the low of the ranges and sell the top of the ranges. I don't see many traders using this indicator, but this is a good tool to filter trades during accumulation and distribution periods. Did you know that with the daily open price, you can anticipate the trend direction for the rest of the day? That's because the open price provides a standard support and resistance function on the chart. If you look at this market, notice how price never remains still around the daily open level, unless it's a sideways trend. The opening price represents the balance between bullish and bearish forces. When prices are above the opening price, the market is considered bullish. If prices fall below the opening price, it's considered bearish. When market is active, price doesn't stay around this level of the daily open price, but forms uptrends above the line or downtrends under the line. If the current open price line is higher than the previous one, consider taking long entries during the day. If the current open price is lower than the previous one, consider taking short entries. This approach is similar to the central pivot one. You want to find trends and to trade a continuation in the direction of the short-term trend and look for reactions at the daily open price. If price starts hesitating when reaching this level and suddenly bounces in the opposite direction, you want to trade in the direction of the bounce. If this line coincides with the supply or demand area, again, it's a key zone to monitor. If you're a moving average trader, I highly encourage you to use a moving average channel. When you apply a moving average on a market, you focus on one single line, which is plotted based on the closing price. That's a very small margin. Instead of plotting the moving average based on the closing price, use a moving average channel. Two moving averages which are applied to the candle's high and low prices. This is very useful for staying out of the sideways markets. The channel turns a simple moving average into a zone of support and resistance. In a market with a strong trend, prices may trade either above or below the 200 EMA channel, which is my preferred length for the moving averages. You can buy or sell breakouts above or below the moving average channel, or you can use the channel's support and resistance areas to establish positions in the direction of the dominant market trend. A confluence with a support or resistance level, or a confluence with a supply or demand area, represents a high probability trade. A break of structure is the first sign that the market may be about to get weaker or it's about to reverse. For example, in an uptrend, with price making higher highs and higher lows, if you see a break of structure, meaning if you see that price makes a lower low and a lower high, well, this could tell you that this trend could be weakening or it could reverse. I like to confirm this break of structure with the RSI's 50 level. Yes, it's a lagging signal, but nonetheless, it's a good confirmation to have. The RSI displays the momentum of the price as a value either above or below 50. When the RSI is above the 50 line, a price has upwards momentum, and when RSI is below 50, we have a downwards momentum. A break of structure to the downside, with the RSI crossing below 50, represents a solid opportunity to short the market. Here we have another break of structure. Market was making lower lows and lower highs. This is the point at which the price interrupted this pattern. RSI confirmed the break of structure as it moved up above the 50 level. A lagging signal, but a good confirmation as long as you monitor the price action first. Fibonacci is not quite a trading indicator, but it's an important leading tool to apply on your chart. Price has a tendency to retrace around 50% of any major move. If you look at any market, you can see it happening a lot. You need to monitor the pullbacks to the 50% fib level, as they are high probability levels for price to move back in the direction of the initial move. It doesn't happen every time, of course, but it happens often enough to make it an important tool in your arsenal. So pay an extra attention to the 50% Fibonacci area of a move. This is the first strong upswing after a downwards move. This sharp retracement found resistance right at the 50% fib level. You can use trendline breakouts or other candlestick patterns to confirm the trade at the 50% fib level. If you want to learn more tips about Fibonacci trading, make sure you watch this video. And check out our Academy program if you want to further level up your trading. Until next time.